Welcome to the daily stock review of Megaport. The goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years. I'm sharing the lessons along the way. These are my 5 steps in my investing process. Today we'll go over how I came across this stock and the 5-minute check to see if this business is worth looking into further. These are the guys I learn off. They did pretty well for themselves over just a little while, and by following the breadcrumbs they've left behind, we should be able to follow in their footsteps. If you like the free resources that I wish I had when I first started out investing, including calculators, checklists, and things like that, the link in the description. Now let's get cracked into it. So Megaport is an Australian business. I came across this business by following a couple of other investors on LinkedIn, one of those being Ron Shamgar, and he mentioned Megaport being one of the best pure play AI stocks on the Australian Stock Exchange. So I thought I'd just jump in and check it out. So first of all, for this 5-minute check, I really want to just find the annual report. 2026 hasn't come out yet, so the latest is last year's 2025 report. Already jumped into that, and what I'm looking for is the annual report's financial statements. So financial report is later, but let's just punch through it. All right, here we go. So we got our profit and loss. Pardon me. So I've got revenue here is grown from 195 up to 227, and overall gross profit's gone from 136 to 162. So pretty good. What else we got in here? We come out. We have a loss for the most recent year. Only a small amount though. What are we talking? We're in thousands, so it's 227 million. And we're talking $292,000 net loss for the year, which isn't too bad. Interesting. Where's the main costs and bits and pieces for these? Employee expenses have gone up a little bit. Depreciation, amortization is a pretty major cost. Might have to have a drink. So after that, I want to have a look at the balance sheet, which we're looking at the moment. And this helps us see if there's any little hand grenades and things like that we want to watch out for. So we're going from 105 to 135 total assets. That's in million. 260 million total assets versus total liabilities of 81. So it doesn't look like there's any imbalance here. We always want to have a company that's got more assets than liabilities. What else? Borrowings is pretty minimal. Issued capital. The amount looks like it's increased a little bit. So it's probably sold some shares on the public market during the year to raise a little bit more capital. Now I really want to check out how management's spending that money. So we want to have a look at the cash flow statement. We got our incomes that come out here, or receipts from customers, payments to suppliers, interest received, income taxes, payment of network financing installments. So what we've got here is we had a loss for net income, but there were a lot of non-cash charges in there. So we've come out and the business has actually grown its cash from its operations, which is a good sign. And the payments to property, plant, and equipment has grown, so it's doubled, which we would expect for a business that is growing to be buying and growing its network of either products, services, and the things that make those products and services. Payments for intangible assets. So some things like softwares and different things like that. It might be brands and stuff. Man, I'm dying here. So looking at this business, it does have positive free cash flow, which is our net cash from operations minus our property, plant, equipment. And so we end up with 40 million in free cash this year. It's pretty close to 70. So we end up with 20 minus that. We're getting close up to still around that 50 mark, maybe about 45. So free cash flow or in the business is still growing, which is a good sign. That means that the revenues for the business is making its way down into cash and then down through the business. Now, where's it actually spending the money? So it's got now around 50 million to spend. It's got proceeds from borrowings, so it's borrowed some more money, it's paid some of that debt off. We've got payment of principal portion of lease liabilities, a couple of bits and pieces there, and then financing. So it's got a net increase in cash and cash equivalents at the start of the year, cash equivalents at end of year. So it's held on to a lot of it. And where is our proceeds from issue of new shares? So only in the previous year. So it looks like their cash position's growing and it's still making more free cash flow. So this business is interesting to look at. So it is probably in the process of trying to master its customer at this stage. It's got some pretty reasonable margins on the business in terms of looking at the income statement. Got some pretty good gross profit. That's very high. It's over 50%. And then we've got what would be normalized through here. We've still got some pretty extreme like non-cash charges and things like that are coming through here. So we'd want to check out what these are with note 11 on the notes to financial statements when we do a bit of a deep dive on it. So really this 5-minute check is to see, is this business worth looking into further? And so what can I see? It does appear that it's got a bit of a moat around the business at this stage, whether that be because it's leading the charge where other competitors haven't got to yet, and that's why they've maintained those margins. So it might be something that we've got to keep an eye on there for long term. What's the moat of the business? And then we've got to have a look at the positive cash flows, which is growing as well, which is a really good sign. So even though the price to earnings ratio is undefined here, it's because it was a negative this year for the last year. This business has had a lot of ups and downs in terms of what I guess shareholders in the market are willing to pay for it, because the price is so the growth trajectory is very volatile. So lots of people don't know what AI is going to mean for businesses involved in AI, and if that's going to innovate and completely destroy their business models and things like that. So there's a lot of emotions in the market at the moment. Now with cash flows growing, that's a really good sign, and it'd probably be a benefit to try and value the business and go from there once having a look and doing a bit of a deep dive. So I will be looking at this business further. It does look quite interesting in terms of those financials, and it is cash flow positive, which is a really good sign that they're not just going to be continually burning cash in the hope that they're going to turn a profit at some stage, especially with innovative companies or companies in very innovative industries. We want to have a bit more certainty around what they're actually going to do and if they're actually making some money. All right, I hope you like this one. Feel free to drop any comments below if you've got any questions or any other stocks you guys are interested in. Otherwise, check out this next video because YouTube thinks you'll like it. Cheers.